Hello, welcome back. Today we're going to cover Chapter 20, which is Accounting for Pensions and Post-Retirement Benefits. I would like to note that for purposes of this course, we're going to keep the discussion on this topic at a high level and will not dive into any specific calculations required for pensions and post-retirement benefits. As you'll see in the textbook, there's a lot of complexity and detail that can go along with these plans and the calculations, but for purposes of this course, we will not be covering all of that specific detail. You will be responsible for your homework, quizzes, and exams to know the material that is covered in this lecture and the note handout packet that I have provided. I would like to note that there will not be a quiz for Chapter 20, rather just a homework assignment. If you would like to learn more about pensions and post-retirement benefits, I encourage you to read Chapter 20 from the textbook. This will not only help reinforce some of the concepts that we're going to cover in the lecture today, but also provide you some beneficial information that will apply to your current employment or future employment as you begin to start thinking about your own retirement and the type of plans that your employer may offer. So let's go ahead and dive right into it. First, we're going to discuss the nature of the pension plan. A pension plan is an arrangement whereby an employer provides benefits to employees after they retire for the services they provided while they were employed. Another way to think of this is it is a form of deferred compensation in which the employee is earning the money now while they are employed and the work that they put in, but they will not receive that compensation until a later date. There are a few type of plans for pensions, but I'm going to go through these. These are the two primary definitions and what the plans fall under. So we will cover just these at a high level. First is a defined contribution plan. A defined contribution plan is when the employer agrees to contribute a certain sum each period based on a specified formula. This is most commonly referred to as a 401k. This is in the circumstances where an employer says, I will contribute 3% every year, 3% of your salary every year to a 401k if you put in, as the employee, 3% of your salary every year into your 401k. The employees bear part of the cost of this type of plan and the stated benefits, and they voluntarily make payments to increase their benefits. So this is a circumstance where an employer may say, I'll put in 3% if you put in 3%. However, you may put in as much as up to the federal law limit for your contributions. Therefore, as the employee, if I want to contribute more to my 401k, I could put in, say, 10%, knowing that the company is only going to put in 3% of their own money. But that additional funds I put in as the employee will make my contributions to the plan higher and also increase my benefits at a future date. The accounting for a defined contribution plan actually is relatively straightforward. The employer's responsibility is to simply make a contribution every year based on the formula established. So this would be, in my earlier example, where the employer would put in 3% of your salary every year if you put in 3% of your salary every year. Thus, the employer's annual cost is the amount that they are obligated to contribute to the pension trust. And the pension trust, just as a brief side note, is where the money and contributions are being held, for which at a future date they will use to pay these funds and contributions out to the employees that have retired. Next is the defined benefit plans. A defined benefit plan is the benefits that the employee will receive at some time after retirement. This is most commonly referred to as a pension. Please note that you can pull sometimes a pension out early. However, there are income tax laws and penalties that are associated if you pull them out before specified dates. Under this type of plan, the employer bears the entire cost. The amount that they determine they owe you upon retirement is a very complicated calculation which involves the use of actuaries and various uncertain future variables in determining the amount that they're going to have to pay you. Therefore, they have to come up with a funding pattern that they need to establish to ensure that they are contributing enough money to a trust to hold to be able to meet the retirement obligations they have promised to the employees upon their retirement. Next, under C, you'll see this is just highlights who bears the ultimate cost of the plan. I will note that the materials under items A, B, and C, these would make for good short answer or multiple choice questions on a quiz or exam. So I would make sure that you understand those topics. Next is a qualified pension plan. The federal government allows certain income tax benefits if companies design their pension plans a certain way. If they meet these requirements, they receive these tax benefits, and they are known to have a qualified pension plan. If they meet these requirements and are notified and noted as a qualified pension plan, this allows them to deduct their contributions to the pension plan fund and tax-free status of earnings from the pension fund assets. Therefore, when they invest money, they set aside these assets to cover the liability that they'll ultimately pay in the future. During this time, they are able to invest these assets to earn money, to make their contributions to this trust higher, so they have more money to pay in the future without actually having to keep setting aside more money. Next, the pension fund should be a separate legal and accounting entity. Therefore, they would have to maintain their own set of financials and prepare their own financial statements. This is a key component to a qualified pension plan. And as when I was in public accounting, I undertook a multiple audits of pension funds, and it is a very interesting process to see the type of things that the company has to calculate in order to determine the appropriate amount of money to hold for the future retirements of its employees. Next, we'll discuss briefly the role of actuaries. So because the problems associated with pension plans involve complicated actuarial considerations, actuaries are the most significant piece of this calculation. Using their knowledge, they make predictions with actuarial assumptions of various items, and as you see there, I listed a few: mortality rates, employee turnover, interest, earning rates, early retirements, future salaries, and other factors to operate the pension plan. So they use all of this information and come up with a very complex calculation to determine at each period, when the company reports their financials, how much they owe at that given time in their pension plan to their employees. Next, we're going to briefly talk about the accounting for pensions. So the pension obligation is a deferred compensation obligation the employer has to its employees. The easiest way to look at this is it's the liability the company has for the pension. And so they will record a pension liability, for the amount that they owe to their employees at a future date. First, I highlight vested benefits. Vested benefits are the benefits the employee is entitled to even if no further services are rendered to the company. Therefore, under this example I have put here, I just would like to highlight a little bit. So every year the company sets aside $1,000 a year that you are employed, and they said if you stay with the firm for 5 years, after that period you will receive the full amount of money set aside. Therefore, once you have greater than 5 years of service, and if you decide to leave the firm, you will be entitled to the entire amount that the company was obligated to pay you, which would be the 5 years times $1,000 or $5,000. One key note here is that if you leave the firm, often if you leave the firm before the vesting period is up, you will receive a proportional amount of that money that's set aside, whether it's after 3 years they give you 50% of the money, and so on. Next, I'd like to briefly talk about the measurement of the pension obligation. So these are the two ways in which a company can calculate the pension liability. First is the accumulated benefit obligation, or the ABO. The key thing to note here is that it uses current salary levels of its employees to determine the benefit or the obligation they owe to the pension. And then under B, the projected benefit obligation, the key note here is that it uses future salaries to determine this calculation. That is a key distinction to note, and do not be surprised if this is on your homework quizzes. Sorry, you will not have a quiz on this chapter, on your homework or your exam. One thing to note about the PBO is that since future salaries are expected to be higher than current salaries, this approach results in the largest measurement of the pension obligation. Next, I'd like to touch on the components of pension expense. So these are the things that the company has to calculate and consider on an accrual basis when they're trying to determine what the expense is for them to operate this pension on a yearly basis. It's a quite complex function and calculation to determine this, and the schedules that we're not going to discuss here but are outlined in the textbook kind of show you the process of how the company would establish the pension expense. But these are the 5 main components, and I will go over them, each of them briefly. First is service costs. This is the expense caused by the increase in the pension benefits payable to employees for their services rendered in the current year. So this is the amount of money that the company is setting aside for their employees who worked during the current year. So if they have it set up where they calculate that all of the employees that worked this year, based on their current salaries or their future salaries, depending on the measurement of the pension obligation, we owe $100. If they owe $100 added to the pension benefits payable, that is what they would be recognizing as the service cost. Next is the interest on the pension liability. So because the pension is a deferred compensation arrangement, it's recorded on a discounted basis. Interest expense will accrue each year on the projected benefit obligation based on a selected interest rate called the settlement rate. Next, the actual return on plan assets. Annual expense is adjusted for any interest and dividends that accumulate within the fund, as well as increase and decreases in the market value of the fund assets. As I mentioned earlier, when the company contributes money to a plan, they take those assets and they invest them in order to try to increase the number of assets they have available for the pension. Therefore, this part of the component of pension expense is just being reflected of any changes in those fund assets. 4 is the amortization of unrecognized prior service costs. This I do not expect any specific details on how this is calculated, but essentially this is related to the fact that the employer will realize economic benefits in future periods. Therefore, the cost of providing these retroactive benefits is allocated to pension expense in the future. Therefore, there is a calculation done to recognize specific amortization of prior service cost. And number 5 is the amortization of unrecognized net gain or loss. And there's 2 items that comprise this gain or loss: the difference between the actual return and the expected return on plan assets, and 2, the amortization of any unrecognized net gain or loss from previous periods. So that is all that I have for now on pension plans. I would like to note, this is at a very high level information, and so you will not be expected to know much more detailed than this. So if you can understand the information outlined in the note packet and also as we just discussed, you will be just fine for your homework and the exam. And lastly for today, I'm going to touch briefly on post-retirement benefits. So post-retirement benefits include the health and welfare benefits other than pensions that are provided to a retiree. This includes the 5 items I've noted on in bullets there: medical, dental, life insurance, group legal services, and other benefits. Healthcare benefits are the most common, and eligibility is usually based on your age and or years of service with the company. I have highlighted just a few key differences between pensions and healthcare benefits, generally just to highlight the difference between pensions and post-retirement benefits. First, there is a difference in the funding. Second, the benefit that is being paid, while under pensions it is well defined, under healthcare it's generally uncapped, and there's a lot of variability. You may not always use the benefits. You may not, one year you may go to the hospital 3 times. The next year you may not go to the hospital at all. Next, the beneficiary. Under pensions, it usually applies strictly to the retiree. However, sometimes you can apply your pension to your surviving spouse in the case of your death. And under healthcare benefits, it usually helps cover the retiree, his spouse, and dependents. There is a difference in the benefit payable. Usually pensions pay out monthly or annually or weekly. It's really based on the structure of the plan, whereas healthcare benefits are more of an as you need it, you get to use it. And then the predictability is the main takeaway here. That under pensions it's variable, but they can reasonably predict the amounts based on their actuarial assumptions and the calculations that they do and the history that they have of the pension plans. Whereas healthcare benefits, it is very tough to calculate the utilization estimates that they may have. This will also vary across geography and fluctuates over time. Now, there may be, for example, there could be a outbreak in Georgia one year that requires a lot of medical coverage and a lot of life insurance. However, in California, there may be none used. There may be no significant medical or life insurance. So it's very tough to determine the benefits that will be used under healthcare benefits for post-retirement. So for today, that is all that I have. Hopefully this information makes sense. Please let me know if you have any questions over the material that is outlined in this chapter. I would like to note that your homework associated to this is very, very short, and basically is asking you to just restate a lot of the information that is in the lecture. But one thing I want to get a bit of advice with regards to this chapter as you're preparing for the exam is making sure you understand the differences between the certain items. So for example, making sure you understand what the difference between a defined contribution plan is and a defined benefit plan. Also, would like to note the difference between the accumulated benefit obligation and the projected benefit obligation. And then also, lastly, make sure you have a basic understanding of what the components of pension expense is. I would not expect you to know specifically in detail how each of these components functions. However, just being aware of what the 5 key components of pension expense are will be useful on the exam. That is all that I have. Thank you again for listening. I hope you are able to apply this information to your homework and everything makes sense, and good luck with this information on your first exam. Have a great day. Bye.